The Hedgeless Horseman here. It's October the 27th, 2022. This video will be about a post I did a week or so ago, and I will discuss a few topics that's been on my mind lately. First of all, the topic of this post was musings about best value. And first of all, I state the fact that physical gold and silver is, of course, given the severity of the problems to the global financial system out there, those are that's the only risk-free stuff you really have. Miners are still fraught with risk. So basically, I see them as pretty much completely opposites. Not completely opposite ends of the spectrum, but any company has risk, and there's a lot of exploration risk and mining risk. I just compiled a list of the developers that have been unsuccessful getting into production just in the last year or so. I think there's at least 8 cases. There's barely any case where a junior has successfully transitioned to become a producer in the last 12 months. I guess Minera Alamos, but that was a bit earlier, but that's one of the few successes. Main point, the physical metals that's the hedge I see to my precious metals portfolio. So from a risk on perspective or a investing perspective, I don't think there's a better sector value-wise, risk-reward-wise than precious metal miners. But at the same time, they are risky. So my hedge to that is to, the completely risk-free stuff, physical gold and silver and platinum and whatever you want. My second point was, if one wants to own explorers, I think one should primarily stick to tier 2 to tier 1 post-discovery plays in this environment. There's a reason for that, and that's because sunk costs and sunk risks, if one could call it that, are so cheap right now that you really have to have, in my opinion, an exceptional exploration story. Otherwise, the risk-reward doesn't really add up, because you can buy tier 3 and below success right now much cheaper, or the risk-reward is much better than buying, in my opinion, pre-discovery grassroots exploration plays that have not yet, let's say, made a discovery or a significant discovery. And then I just have some check marks for the perfect hodl cases, basically. Preferably margin of safety, years of runway for growth, less need for timing, high inside ownership. They will lie awake worrying about the company more than you do. Competent management, time is the friend of a good management team. Good access to capital allows for higher value creation pace and less dilution. Especially right now, access to capital is pretty material, because there's a lot of companies that are out of cash or close to out of cash, and really don't have strong backing. So you need retail participants, and obviously typically I would say retail are worse than even the institutions. So they will need a really sweet deal for financings to participate, and that's obviously a negative for the current shareholders. But anyway, let's get into it a bit. I've been thinking lately, and I have been picking up some microcap companies, typically stink bids, typically not hitting the ask, simply because where we are, it's like I showed in the last video, sentiment is absolutely atrocious, and we are in tax loss selling season. So this is the time where majority of people tend to make the biggest mistakes, which is selling And if you have artificial selling like tax loss selling, I mean that's mwah. There's some obscene opportunities you can get in tax loss selling season. Typically because they're already down, so they're already undervalued, and then you have artificial selling on top of that, where the persons selling the shares, I mean the whole point is to have a big loss, or that they have a big loss, so they don't really care because they're going to use the tax loss to offset some capital gains if they have some. I mean, I don't expect the tax loss selling season to be that bad this season, simply because I don't think there's too much to capital gains. But if I understand correctly, someone told me that in Canada you can actually have, use capital losses to offset gains for the next 3 years or something. I'm not sure if that's correct. If that's the case, obviously that's very good from a bargain hunter perspective, because the people might be more inclined to actually take capital losses anyway right now. And again, which I've showed before, I mean, it might not look like much. If you buy a stock right now at price X versus price X minus 10%, that might not look like a lot, because okay, it's maybe down 80%, and if it goes down 10% more, it's down who knows, 82% or whatever. Still, that might be a huge difference in the future, just that 10% difference. So that's why, I mean, the cheaper to get, the risk reward and opportunity goes really exponential. So what not might look like a big deal in the grand scheme of things, something down a lot versus a lot plus 10%, might have actually huge impact on your future returns. But with that said, I find myself, like right now, I've looked through, I think, I don't know, or briefly looked through around 30 microcap companies, trading, sub 10 million, some down to like 2 million. The thing is, well, first of all, the crappy companies, and even if they're not crappy, the cheapest companies in absolute value, I mean, they can go up the most from sentiment low to sentiment bottom. So I mean, if there's a company you're buying here at 2 million market cap, without the company doing much, if we go into a better sentiment environment again, I mean, from sentiment bottom to next medium term high, they can go up 400-500%. I mean, typically in this, well, especially around this period, and I guess around this period, there were simply not many microcappers that were trading below 10 million market cap. Now there's a lot of them, because as you may or may not know, I mean, some people just look at the valuation. And if they find a sub 10 million market cap company when everything is almost no companies trading below 10 million, they think it's cheap just based on the market cap, even though it can be grossly overvalued, or a company that's actually has a market cap twice as high is a lot cheaper. But that's how people work. I mean, I know some friends who believe that the price per share is a evidence of a company being cheap or not, meaning that if you pay 5 cents per share, that's a cheaper company, cheaper stock than 6 cents or 10 cents, even though you all should know that I mean, it depends on the shares outstanding, and obviously you should relate that to the actual value of the company. But that's how people work, and that's again one of these, one could say, edges, that you're front running a period where people are greedy again, and in that case there will be, I mean, the ones that are typically buying the top, they will obviously be the one that has no clue about risk reward or price to value. So at those times, like in really high sentiment environment, that's the people you get, who literally can buy a company simply because it has the lowest price to per share, or market cap. I mean, that's, I guess, on the next level. But as I went through a lot of these micro cappers, and again, knowing what happens when we go from a low to a high, so I know that I've seen plenty of examples from especially this bottom, where micro cappers went up like 500 to 1000% without doing much, really. I mean, nothing really changed for the project. Obviously, they didn't have a lot in terms of money down here, so it wasn't even possible really to create that much value in the next 8 months. But still, they went up 500 to 1000%. So that's what gets me greedy from that perspective, knowing what happens with micro cappers going from a extreme low to a high, or even extreme high. But the thing is that I find it quite hard to actually buy a lot of these micro cappers, simply because if you reverse engineer the success of more de-risked plays, the risk reward doesn't really add up. Because if you have, take Timberline Resources for example, I mean that's a quite advanced exploration company. I mean they have a Carlin system. They've hit 100 gram meter holes of Carlin mineralization in the Eureka district, just south of I-80 gold. So when you look at a company that's exploring for Carlin gold, which has not yet really hit anything, if that has a market cap of 5 million, and let's say Timberline has around 20 million right now, so that's Timberline has 4 times the market cap of said pre-discovery play, and by extension one could say that there's a 25% chance priced in for the grassroots exploration company to have something similar, or to be at the stage that Timberline Resources is right now. Problem is obviously that, first of all, it's very rare to find a good gold system, especially in a tier 1 jurisdiction. That might be one in, I don't know, one in or let's say 5 in 100 companies, something like that. That is able to do that. So first, the chance of success, which is extremely low to actually even make a discovery. Then, if that happens, then they also have to dilute to get to the stage where a post-discovery play is already at. So if you do the math on that, almost no grassroots exploration company or pre-discovery exploration company right now looks cheap relative to their more advanced peers, which might be trading at 4 times their market caps. I think that's a very important point. And again, that doesn't mean that they can't go up more than the de-risked plays. It simply means that from a rational value and risk-reward perspective, it doesn't make sense to pick them over the de-risked plays. Because there are, again, a bunch of, it's like, I just looked at one example here, Gold Hunter Resources, apparently a very, kind of brand new company. Just found that today, and, checking it out. Okay, 5.7 million market cap. They have, I don't know, maybe they're going to do an acquisition or whatever, but according to, they don't even have a presentation out, I think. According to their, well, first of all, again, it's like you see that, okay, 5.6 million market cap. I mean, that could easily bounce to 15 or more in a good sentiment environment without anything having changed for the company. Just that there's more buyers and people see, 5.7 million. I mean, that's cheap, based on nothing but the market cap. Well, let's look at, they apparently have 2 projects like Cameron Lake East. Yeah, some nickel over narrow widths, low grade gold over. I mean, this is really nothing to write home about. There's plenty of projects where you can find stuff like this. similar. I mean, again, I mean, this is not really something to write home, but that doesn't mean that they might not make a discovery or something here. It's just that given the stage, I mean, this is not exceptional in any way. Then they, I think, have picked up more projects in Newfoundland. It's close to Rambler Mining's mine. Other than that, I mean, yes, there's a lot of historic mines or prospects or whatever, but it's like, this is not de-risked at all. This is, yes, there might be some prospective ground here. But take this, for example. I mean, if this, I don't know what the actual main goal here is, if it's precious metals or nickel. Anyway, so you have this 5.7, and then you have Magna Mining at 47. So if you're looking for, let's pretend that this is primarily a nickel play, even though it appears to be both gold and nickel. But take any grassroots nickel play, and you find it at 5.7 million market cap, and you're like, yeah, that's so cheap. I mean, I can make a lot more money in that than Magna Mining is at 47 million. But when you actually think about it, it's like, okay, what does that imply? That implies, their market cap implies over the difference of 47.4 versus whatever 5.7. Over a 10% chance that they will reach the stage and have similar success to what Magna Mining has already. Meaning a drilled out feasibility stage, permitted open pit project, permitted for a mill, and the new Green Hill Mine / Denison project, which is probably, we don't have the resource out yet, but I'm guessing a few million tons of high grade nickel PGM mineralization with plenty of upside. Past producer, potential for near-term cash flow, excellent infrastructure, close to smelters, close to mills. There is no way in hell that Gold Hunter is cheaper than Magna Mining. So even though this space is absolutely in the dumps right now, and the entire space is pretty much cheap, I still think that if you compare, especially de-risked companies with sunk costs, they are like 1,000% cheaper than a lot of grassroots exploration plays. Even though if you just look at the market cap, it's enticing because it's like, yeah, at 5.7, these can run a lot. But if you actually back engineer how long it would take, how much money it would take, and risk adjust, the permitting risk, infrastructure, all that, this should probably be trading at 1, meaning it's like 80% overvalued still, if you compare it to what de-risk success is trading at. And that's why in the case of Magna, for example, I mean, I have some lower conviction plays out there. I mean, some positions are like 0.5%, some 0.2%. I have a much larger position in Magna Mining currently, which means that if I have 1,000% higher stake in a company like Magna, it implies that I think the case for Magna Mining is 1,000% better than whatever junior, where I had a much lower stake in. And I think that makes absolutely sense. So I guess the point is that, I mean, step 1 is realizing that where we are in the sentiment cycle. This is the time to be very aggressive, increasingly aggressive the lower this goes, increasingly defensive the higher this goes. At the same time, I mean, if you just do that, I think you can do well just buying, 55 million market cap companies and waiting for a change in sentiment. Assuming they'll be around, they'll probably go up. Some will be gone, some will go up a lot, some will actually make maybe a discovery or two. I think you could do like 300-400% just based on that and be diversified across 50 market micro cappers. That's not my preferred of doing it, because it's like, yes, at least you grasp the beta swing, sentiment swing, and that's good and all. Just that I prefer to, again, have the absolutely best risk-adjusted returns I can possibly have. So for me, it's not enough just knowing that, yes, this sector is overall a buy right now, because I think the opportunities within the sector might differ by 1,000%. I might be wrong, but that's how I view it. And one reason for that is, again, if you just compare the de-risked companies with sunk costs, they have already, they're one of the few, let's say, again, 5 in 100 companies that actually make a discovery. They've spent a few $1,000,000. They might have some permits, etc. To replicate that would dilute a company like Gold Hunter a few times over, probably. And you would have to wait, obviously, in order to drill all that up, to get the permit. So it's not just the capital cost, it's the time cost as well. And that also has to be de-risked at the same time with the chance of success. Because if you have a permit, if that cost, I don't know, 2 million and took 3 years, that's worth more than the 3 million in 2 years, because you could spend that much money and wait that long a time and still not get the permit. So if you risk adjusted is worth really more, at least in this day and age, than the face value of the costs in time and money to actually get the permit. At least if you compare it to a company that is not yet at that stage. But if there was a guarantee that, it costs 2 million and 2 years and you'll get the permit, 100% sure, yes, then in that case, you could just factor in that face value cost, because you knew it had 100% certainty. That is not the case in this day and age. So, that's how I like to, because I think one of the risks that I'm faced with right now is being overly greedy when you should be rationally greedy. Because yes, I am greedy right now, which I think you really are supposed to be. But you can also be overly greedy. And again, that does not mean that someone that is overly greedy right now, that is just into micro cappers across the board, might outperform my portfolio going into the next sentiment high. That is a real possibility. I still don't like it from a risk reward perspective, because it more more comes down to timing. That if this continues on for like 6 additional months, etc., there's a higher risk of actual bankruptcy, there's a higher risk of actual dilution, plus they won't be creating any value over that time. Even if a slightly better company, slightly de-risked company, has to do some dilution right now, but dilute at not the best time, obviously. Still, if they just create more value than the dilution, let's say, the value of the company still goes up, even though it's lower per share because of an increased dilution. Still, that can be worth it, and you actually get paid to wait in that case, even though you would hope that they would didn't have to dilute at these levels, obviously. But again, assuming there's probable growth, it's a good project, they'll probably create more value than it costs even with dilution. So that's another thing I like. And thought experiments like this is pretty much how I keep myself in check, because I know that I am very aggressive right now, and I should be very aggressive right now, but still being overly greedy is a mistake. I mean, being fearful and passive or defensive here, depending on how you look at it, is a mistake. But also being overly greedy is always a mistake. I mean, being greedy here is a big mistake, but overly greedy at times where you don't need to be, because you can be rationally greedy with a much better risk reward, that's just firming up your investing strategy even more. That means you're probably gonna have even better long-term results, because again, it's like all our long-term results comes down to the quality of our decisions, and that is every minute of every day. We can't just, I mean, yes, if I was better at selling, like selling tops, etc., my returns would be better. But you can't be perfect. Just getting the, in my case, just being able to buy when this sector is extremely cheap has been enough to have very good returns so far over the last 7 years. So I don't expect that to, or I don't want that to change. I just want to add as many edges as I can and not fall into the thousands of pitfalls you can fall into. And one, I think, is that if you're aggressive, which I think makes perfect sense right now, there's still a mistake if you're overly aggressive. And in my opinion, pick the stuff with worse risk reward than the proven stuff. I mean, again, I-80 Gold, perfect example. They have their infrastructure alone and the sunk cost of drilling up everything they have. I mean, probably over 1.5 billion. Market cap is 500 million. So again, that took years to build and permit and drill up, and it would have cost like 1.5 billion. So I mean, I-80 Gold is extremely cheap in my opinion. Probably one of the absolute best risk reward plays out there, especially when you account for the incredible margin of safety and sunk cost. And the stock has been punished lately, which I couldn't really figure out what was happening, because some days it would go up a lot and then down a lot. So it's just been zigzag. Apparently, based on what I read in the forums, there's a fund liquidating. I mean, that's I mean, really, really great, and would explain the, in my opinion, irrational zigzagging or the swings. Stuff like that. I mean, it's akin to tax loss selling. You have a motivated seller, doesn't really he's getting out for whatever reason. If it's redemptions or they're liquidating a fund or whatever, they have to get out. They don't care about the undervaluation in that case, because that's like a bureaucracy. A decision has been made. So I'm quite happily surprised to see that. I hope they sell for some time more, because I think it's just ridiculously undervalued. Line 1 Metals has a lot of sunk cost as well. Fully permitted, going towards production. Now there's a bunch of examples of upstart producers who didn't make the cut, so that's always a risk. Still, again, if you look what it cost in time and money, and the chance of success of even finding an alkaline gold system, every 5 million market cap company out there is going to look very, very, very expensive relative to Line 1. There's a few micro cappers that I think are, good risk reward. Against District Metals is cheaper than Gold Hunter. I don't think that makes sense at all. Headwater Gold, it's revalued recently. They have a bunch of projects, top tier management, funded by Newcrest. So I mean, compare that. I mean, that's still very undervalued relative to a pre-discovery grassroots exploration play with a few chip samples. They already have drill confirmation at like 3 projects or something, and the vote of confidence from Newcrest. So that's what I mean by, it's like, yes, this sector is incredibly cheap right now, but still I think the opportunities within the sector differ by thousands of percent, or at least up to 1,000%, or even more. I think there's an incredible difference in opportunities within the sector, even though it's overall very cheap. And my job is, of course, to set myself up in the best absolute risk reward scenarios, and the best risk adjusted long term returns. On the topic of some exceptional stories, again, I don't think it makes sense to buy early stage or pre-discovery plays. The odds are that even if they find something, and that might be a 5% chance, it's a 90% chance if they find something that it's going to be tier 3 or lower. So the chance of finding an exceptional system is maybe 1 in 1,000, 1 in 500 or something. So that's the only one, because you can't replicate these three. I mean, Snowline, for example, there is no example right now that I'm aware of a target of the size of Valley with the apparent grades of Valley. Meaning multi-million, in my opinion, probably 10 to 20 million ounces at very good grades for a reduced intrusion related gold system like they have. You can't buy that kind of success anywhere. There are examples of Banyan Gold and Victoria Gold, etc. They look to have lower grades though. I mean, they might find something better, but right now you can't even replicate. You can't buy a more advanced version of Snowline. It is that, in my opinion, exceptional right now. Same with Goliath. Exceptionally predictable system, high grades, at least so far, appears to be pretty thick, appears to be very large, metallurgy looks good, it's underground and might have gravity working for it because you would have the mine portal below the actual ore body. So you wouldn't need to, I mean, typically you have an underground mine, you have a shaft or something, so it costs a lot of energy and thus money to actually bring up the ore. In this case, you would bring it down. So how nice would that be? And I mean, it's probably low tonnage, which is also a good thing. Still, I mean, there is no ore body that I know of, or a deposit that shares those characteristics. Western Alaska, bonanza grade CRD system. And it appears they've just scratched the surface of a system that's measuring many kilometers in diameter, and they're at one CRD trend, following one structure. Those grades, I mean, you don't even see a lot of CRD systems with that grades and that scale, etc. Huge insider ownership. That's an exceptional story in my opinion. You can't buy a more de-risked version of that with growth potential right now. So those are the types of exploration stories where I'm comfortable being quite heavy in right now, even in a time where almost no early stage or pre-discovery stage companies make sense from a risk-reward perspective versus the de-risked ones. Because these don't have really the more safety per se. It's just that they are not expensive relative to how valuable their kind of targets could be. And in these cases of the more advanced ones, they are cheap based on what they have and how good looking their projects are. It's so they're cheap already, even though they might not have. I mean, who knows? Maybe some of these will actually be tier 2 to tier 1. I mean, that's still up for debate. I think I-80 Gold, for example, might have, maybe 2 actual tier 1 deposits. And Line 1, we know that could be a huge one. And with time, maybe Timberline will have one of these famous, very large, multi-million ounce Carlin systems. Maybe a tier 2 deposit. But main point is that a lot of micro cappers that don't even have a tier 3 or tier 4 project right now because they haven't de-risked it to even have a clue to know that. They're actually, even though they're at face value, they're extremely cheap. And you typically don't see that too often unless we go into these the abyss in terms of sentiment. I think they're still overvalued relative to the more advanced micro cappers, which might have other things going for them, and de-risked sunk cost plays, and the exceptional stories where the grassroots exploration, they might have a 1 in a 500 chance to have a system like some of these guys. And if they end up having that, they will have to, let's say, raise 40-50 million to even get to the stage where some of these others are. So again, if you reverse engineer the chance of success, time and money it would take to even get to the stage of other companies, they don't look cheap anymore. Obviously, the lowest risk ones are the more the margin of safety plays I've talked about. Like there's Nighthawk Gold, a lot of cash. I think Bonterra, for example, I think they're probably gonna have to raise one of these days, but they have a lot of sunk cost and a permitted mill. And I think, judging by forum chatter, they were actually, or Cisco Mining actually put a bid on them at $1.6. So if they're not too far off, Bonterra, the case hasn't changed that much, so maybe fair value is at least $1.6, at least according to Cisco Mining, and they're not the dumbest folks around. So again, that's like, if that's true, that's an external party says that okay, at least $1.6 per share, at least at that point in time. So that's x amount of times the current share price and market cap. Is there anyone out there that would say that Gold Hunter Resources, for example, with some rock samples and some okay land package, is for sure worth like 4 times what it is, or 5 times up to 20 million market cap? No, for sure not. In that case, makes no sense that some of these companies shouldn't be valued a lot higher. If 20 million would be fair value for these pre-discovery plays, imagine what these developers or advanced explorers should be valued at. Again, it's just a topic of the day basically that I think that it's like a risk that I see myself facing, is that I become overly greedy in a time where you should always be rationally greedy at times like this. And again, I've looked through maybe 30 companies, micro cappers, like 10 to 2 million market cap, and a lot of them, yes, they are cheap. Absolutely, they are cheap. A lot of them are cheap. It's just that they're not as cheap as the more advanced ones when you again factor in all this. But that doesn't mean that some won't go up 500% to 1,000%, especially if the market turns around tomorrow, for example. So I have actually put in some stink bids in some microcap juniors that are really, really not high conviction plays, but it's like almost for fun. If I can get some stink bids, somebody sells into me during this tax loss selling season. We're talking 0.1% positions, etc. It's just that I think they can actually, maybe do 500 to 1,000%. But if they don't, if they go bankrupt, or if they don't if they dilute like hell or whatever, maybe I lose money, but that's 0.1% of my portfolio. Doesn't matter. I mean, some of my high conviction stories are, thousands of percent higher stakes anyway. So it doesn't really matter. I mean if some of these, do 50% in the next year, whatever, they will have paid for, I don't know how many of these high risk, high reward plays that went to zero, basically. So I tend to, again, I own a lot of different shares right now, but it's the high conviction plays that make up, some 60-70% of my portfolio. And I think they alone are probably gonna do wonders for my portfolio. But then I don't mind dabbling into some other stuff. But I think, it is a risk that one gets overly greedy and just, I'm gonna go all in a few, sub 5 million market cap companies, because when this sector turns around, they could go up 500 to 1,000%. Again, sure, yes, that is very much true. I mean, from this point here to there, it might go up to 3,000%. It's just that I'm much more comfortable having probable returns than very high potential returns. Because one of these days, something might, happen. If you're not diversified enough and you're only in high risk, high reward plays, maybe you're gonna bust out one. Almost go bust. Who knows? Just I prefer to have high expected returns than a low chance of extremely high returns. And of course, I mean, if some of these micro cappers put out financings with full warrants, I'm participating in Kootenay Silver's private placement right now. I think they included 3-year full warrants. I'm not totally sold on Kootenay Silver. I mean, I don't think they don't have an exceptional project, or they have many projects, but I don't think they have an exceptional project or anything like that. It's just that the added upside of 3-year full warrants means that the risk reward gets so skewed. And if you can get in at a time like this, again, it's like if you ride one of those with full warrants to the next sentiment high, the returns might be pretty mind-numbing. But not a big position. Again, it's like, I don't know, maybe 0.2, 0.3%. But if that alone does well, might contribute, who knows, 15% to the entire portfolio from that 0.3 position alone. Well, that might be an exaggeration, but let's say 10% or whatever. I mean, that alone would be pretty sweet. That's rational greed, in my opinion, because obviously warrants are risk-free upside. So if I could go into a bunch of microcap companies that are very cheap or expensive, actually, relative to the risked ones, but I get full 3-year warrants, etc., that changes the case a lot. Because the chance of success needed for it to make sense goes down by quite a margin with full 3-year warrants, etc. I hope some of this made sense. Again, just recapping that, in my opinion, just don't go buy anything that's cheap at face value. Again, I haven't looked into Gold Hunt Resources to really have. They might have an ace up their sleeve, etc. It's just that it's an example. Like use Bear Creek Mining as an example of junior sentiment, even though I'm not piling into Bear Creek Mining simply because it's at it basically hits this every 8 years or so. and what happens afterwards tends to be very good things. But I don't even know if Bear Creek Mining is going to be around. I mean, they have financing problems, etc. Yeah. So again, point being that be rational about it. Just don't look at market cap. And personally, I like to, when I'm unsure about, if I find a microcap company and think, oh, should I buy this? It's so cheap at face value. But then I compare it to some more advanced plays, and then I just reverse engineer. Okay, how what's the chance of success of reaching what some of these other companies are already at? What chance of success is priced in? Typically, right now, there's like a 25% chance, maybe priced in, that they'll find a tier 3 discovery or something, which I don't buy at all. And then you have to account for the dilution to even get to the stage where the risk tier 3 asset companies are already at, and the time to get there. So again, from a rational speculator investor perspective, pre-discovery plays are overvalued, in my opinion, relative to the post-discovery plays. But again, with that said, doesn't mean that some of these micro-cappers won't go up more than almost anything else. It's just that that's more, in my opinion, high-risk speculation than, it doesn't take a genius to look at I-80 Gold and say, Jesus, if that's going to be worthless, the whole sector would be worthless, and then it doesn't really matter. And it looks to be, should probably be worth, much more than where it is now. But I can't say the same for Gold Hunter Resources, for example. So that, by definition, then becomes, if I buy this is a pure, FOMO trade, or, front running the FOMO going from here to here, and that's again more speculative. Like the silver juniors typically have always been, in my opinion, for the last 7 years, always pricing in a higher silver price than the current silver price. So that's a speculative premium that I typically haven't been willing to pay up for. Now I think actually silver juniors are losing some of that speculative premium, and I think that is another sign of just how bad sentiment is, that the diehard silver bugs, etc., they're kind of throwing in the towel. They're giving up on the silver price. That's what it looks to me. That their belief in a rocketing silver price is going lower, and for the first time in at least 7 years, it looks like, even silver juniors are actually closing the undervaluation gap with gold juniors. Just my thoughts. Consider me biased. Assume I am biased. I own a lot of companies that I have mentioned. Some are sponsors as well. So do your own due diligence. Always make up your own decisions. I don't share your profits or your losses. Any case have to make sense to you. Otherwise, you'll end up buying high and selling low, and short-term volatility is gonna destroy you pretty much, because you're gonna get nervous every time price goes down, and you're gonna become greedy every time price goes up. Meanwhile, if you really understood a case, you would do the opposite. Like, that it's worth 2x more, and then it goes down, so okay, now it's worth 2.3x more, so I'm getting greedy. And when it goes up and closes that price to value gap, you get less greedy, because you understand that the opportunity is actually decreasing as the company is getting price higher, etc., etc. Thanks for listening. Bye.